Already, markets have positive momentum, and now is the time to reduce risk. And I still got a good amount of cash on the sideline. So even if we had a downtrending market, my hedge will print money. And then additionally, I got a good amount of cash to plug into the market, right? So I love the way I'm positioned. That's why I'm just staying on sides in regards to this. I'm not going too crazy with buys or FOMOing in, those sorts of things.
A lot of positive momentum, and now...
But I'm buying stocks every week. Every week I buy in the public account. Every week I buy in the Patreon portfolio. Every week I buy in my private portfolio. Every week.
Not the time to reduce risk. It's also not the time to be a contrarian. For more on where he's finding some opportunities right now, I'm joined by Matt Orton, the Chief Market Strategist over at Raymond James Investment Management. This is a very interesting thesis. It's not at all uncommon for people to say momentum begets more momentum, especially to the upside. But what about all those valuation concerns? What about tariff concerns? What about the uncertainty and the wall of worry? Are we still going to climb it?
Hey, Dom, always great to join you. And I do think we're going to continue to climb the wall of worry. I actually think having a wall of worry is probably a good thing for the market to overcome and to have, because it means that there isn't just universal positive sentiment throughout the entire market. And I think when you look at where we are right now, we've got very positive fundamentals. There are known unknowns. We know that there's going to be tariffs. There's questions with respect to how they're going to be implemented. There's geopolitical concerns, but there's questions around how they might ultimately resolve. And I think we're going to figure a lot of that out as we move into 2025. But for the rest of this year, we're coming off of a good earnings season where expectations for 2025 remain positive. You've had really strong corporate profit margin, which makes me feel a little bit better about where we are with respect to valuations. And one of the things I tell our clients a lot when they ask about, isn't the market very expensive? The average stock is not expensive when you look historically. There's a number of names, the Mag 7 included, that have gotten pricey, but there's a lot of parts of the market that aren't, particularly when you look down market cap, those companies who are more exposed to the U.S. economy, small caps. That's an area of the market I like a lot because...
Yeah, but I also don't want people thinking like there's not opportunities in some of those big tech names, because that's the feeling a lot of these individuals can kind of give off. It's like there's no opportunities in big tech, like they're all overvalued. That's not true. That's not true. NVIDIA is still a hard stock to make a case that it's overvalued. NVIDIA, you can look at it either two ways. It's either undervalued right now or it's fair value. You can't make an argument that stock's overvalued. The numbers are too damn good. And if you look at the forward P, given the growth rates the company has, even if those slow substantially, you can make an argument that the stock's undervalued. Meta is insanely undervalued right now. It's a steal deal. Google, they have a lot going on with the government, so I understand that some people not wanting to touch that right now. But the fact is, given the growth rates, given that forward P, it's undervalued right now, right? AMD, I know they don't get put in that big tech category because it's only like a $200 billion market cap, which, many of those other companies are a trillion plus. That's undervalued right now. Right? I actually think Microsoft's valuation is very fair right now. Fair to undervalued on Microsoft right now. So, you go through the list, Amazon's undervalued right now, which you saw that stock outperforms tremendously. Keep in mind, Amazon, the only thing that's really held back, I think Amazon would easily be trading 250, 275 right now. But Jeff Bezos has put a lot of selling pressure on Amazon this year, which, has, in my opinion, held back the stock because he's such a massive shareholder. And so when he puts that selling pressure on it, it's a lot, right? Because he wants to fund his rocket company and all those other things he's doing, right? But outside of that, I'm looking at a lot of big techs, and I don't think the valuations are too bad there, right? Apple, you can make an argument that that's trading a little rich. Okay. Tesla, you can make an argument that that's, trading rich. Tesla always trades rich. Get used to it. It's never not going to. It's just going to be a question of how rich does Tesla trade? Is it at a 50 forward P or a 70 forward P or 110 forward P? That's the only question in regards to Tesla, right? So, yeah.
Still very cheap relative to large caps, and you're seeing an inflection point with respect to earnings, and I think that will sustain them moving forward for the rest of this year and well into 2025.
All right, so that small cap story is also predicated on this idea that lower interest rates do matter. At the same time, we've got a cross current of a stronger U.S. dollar on a general basis with regard to some of the policies that we're talking about. All of these things make for a very mixed picture. And by the way, a strong dollar also means rougher profits for large multinationals. I trying to figure out where you exactly, beyond small caps, that you see some kind of opportunity there. Is it still going to be in many of those larger cap tech names?
You know, Dom, it all comes down to selectivity. So that's why moving forward, I think as we go into next year, it's going to be more important what you own. The rising tide isn't going to lift all boats. And that's why I think a lot of the divergences that we've seen this year, where financials are so dramatically outperforming, where only some of the Magnificent Seven and mega cap tech names are actually outperforming, those trends are going to continue because it's supported by the companies that can weather a lot of those headwinds really well into next year. So financials, for example, particularly banks and capital market companies, I think those look particularly attractive because they're less exposed to a lot of those themes. They're more exposed to cyclicality and the strength of the underlying economy here, and the fact that we're going to go through a deregulation phase where that's going to lead to more deal activity coming through, hitting the bottom lines, and a steeper yield curve certainly doesn't hurt. And across the board, higher quality companies have less debt maturity cliffs coming up, so you don't need to worry about the impact of interest rates on some of those companies as much as you would think. Even further down market cap, that's why I emphasize to clients, look for companies that have good free cash flow, growing free cash flow, profit margins, return on equity. All of that's going to help insulate you from some of the issues of rising rates, perhaps in increasing US dollar. So there's ways that you can get around those themes by being very selective in the market. And I think that's going to be very critical moving into next year.
So a lot of good points by that gentleman there at the end. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Check this out. It's extremely important I show everybody this right now. This is a 5-year performance of the QQQ, which just think about it as the NASDAQ 100, NASDAQ, versus the S&P 500 versus the Russell 2000, right? Because if you're thinking about small caps, you got to kind of understand where small caps have been to understand where they're going likely, okay? So what we're going to see over the past 5 years is one of the most insane divergences we've ever seen in regards to the Russell 2000 versus the S&P 500 versus the NASDAQ. I mean, the fact that the Russell, because keep in mind, over a 5-year span, these three indexes should move roughly in line. Now, one might be 5, 10, 15 percentage points ahead of the other. That wouldn't be like questionable over a 5-year span, maybe even 20%. But this is anything but normal. We have 40 percentage points of difference between the Russell and the S&P 500. And we have nearly 100 percentage points of difference between the NASDAQ and the Russell. That's not normal. That is not going to last, okay? But it has been what has transpired here over the past number of years, right? Rona messed up a lot of the small caps. Then you went into the super high inflationary environment, right, which messed up a lot of the small caps, and debt getting a lot higher, which benefited more of the tech-related stocks because those ones actually have unbelievable balance sheets with cash loads and usually low debt or no debt on those balance sheets. So you had a whole multitude. It was like several different factors. All, boom, 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 that all transpired that caused this divergence to happen between all these different indexes. But this is not going to last, folks, okay? This is not going to last, but it has happened, and, if we were to go back in time and you were to know all those things would have transpired, you would have been able to put the pieces together and been like, oh, the Russell's probably not going to be looking good in the next few years, right? Now, check this out. This is from November 2021 through November 2024. We just got back to where we were 3 years ago, folks. 3 years ago. Isn't that incredible? We had obviously the massive drop there, and then we had a whole bottoming out process that lasted like well over a year, right? And then we started our recovery here, and we've just been recovering ever since, right? And we're finally back to where we were 3 years ago. But the important thing to understand about that is we just got back to where we were. It's not like we're at some new record high for the Russell and it's like some crazy number like, whoa, we're by far way the highest. No, we're just back to where we were 3 years ago. And keep this in mind. This is very important. Inflation has ran at what, 13% cumulative roughly over this particular time period? That means the Russell's well underperformed inflation over the past 3 years, which is incredible to think about, right? Now, what I'm showing you here right now, this looks back at the Great Financial Crisis, okay? I'm looking at the Russell 2000 Great Financial Crisis 3-year chart, okay? So check this out. This looks back at kind of, 2007 going into 2008, right back here, right? And essentially, we know what happened in the Great Financial Crisis. The stock market crashed. We had an epic crash, and that didn't just happen in the Russell. It happened in the NASDAQ, S&P 500, the Dow 30. All the markets crashed that particular year, right? And what's interesting is basically over that 3 years, it came back to life. So even though it had an incredibly violent crash, and this is a different sort of crash in regards to Russell 2000 than what we had recently, right? Because the recent crash we had in the Russell 2000, that was not kind of like a V-shaped recovery. It was kind of like a long bottoming out process, not as far down. You didn't go down nearly as far in this crash, but it was a long bottoming formation, and then we started upward move. Look at the Great Financial Crisis. That was straight off a cliff, insanely violent crash, right? A 50% crash, but then the V-shaped recovery was incredible from that, right? It wasn't like the Russell was down and out for a long period of time. It came back sharply, right? And so basically what we've just watched in the Russell 2000 over the past 3 years is exactly what the Russell went through in the Great Financial Crisis, just a little different in terms of the Great Financial Crisis was much more of a V-shaped recovery, but it went down further. And this one was more like just a slow drag and just being dead for years, right? So the moral of the story, you got to the same place basically in the Russell 2000, just you got there differently, right? Which is incredible. But then what happened after it got back to where it used to be? Then it went on an incredible run. The next 3 years, the Russell went up over 60 percentage points, which is an incredible run for the Russell, right? After that period of time. So this backs it up to, kind of toward the end of 2010-ish, right? Which is kind of where we wrap up this chart here. And that goes all the way into late 2013. Incredible run, 60% plus run over those 3 years. So the moral of the story is, in regards to understanding this Russell situation, is there's a real potential that over the next 3 years, the Russell 2000 goes up 50%, 60%, 70%, 80%. I wouldn't necessarily bank on it in terms of like, let's go buy call options and, all those sorts of things. But the moral of the story is here, folks, I would say the Russell sets up pretty darn well for the next several years, just to be quite frank. And if it does what it did after the Great Financial Crisis, the Russell's going to be a lot of fun for the next several years. Now, that doesn't mean you can't have dips in between then, right? Look at right here. You had a major correction in the Russell here. The Russell here reaches up to about, we can call it about 870 or so. And in a matter of just a few weeks, the Russell went down to 640. So just keep this in mind, like, the Russell run could roll through the, end of this year, maybe into the beginning of 2025. But then there's a potential, like in the springtime or the summertime, you got a major correction in the Russell before it starts its next upward recovery. So don't just think, if it goes up 60% over the next 3 years, it's just going to be in a straight line. Doesn't have to be at all. There could easily be 1 or 2 major corrections in that rally, essentially. Okay, so something to keep in mind there. Now, check this out. I wanted to say, okay, let's look at what the S&P 500 did and the NASDAQ did over that next 3 years, right? So once again, we're looking at basically the same chart we were right here. And check this out. The Russell went up 61% over that time. The Qs went up 66% over that time. And the S&P 500 went up 53%. That's normal. So then you had a normal recovery after that point in time. And that's why if I was thinking about trying to gauge these different indexes together, and I was trying to say, what index do I think will outperform the other ones over the next 3 years? My thought about that is, I think the Russell has a good opportunity to outperform the other 2 main indexes, the S&P 500 and the NASDAQ, over the next 3 years. But if I had to bank on something else, I would bank on the NASDAQ over the S&P 500. So we could get very much a similar phenomenon that like we had at that particular time. Once again, don't bank on it. Don't think like, oh, I'm just going to buy calls and it's all going to work out exactly like it did after the great financial crisis. But there's a lot of rhyming that's going on here when you start to look back at these historical patterns from the great financial crisis and what we went through, what the indexes went through, and kind of what we had transpire, especially in regards to the Russell specifically, right? So that's little food for thought in regards to that. So the moral of the story is in regards to Russell, we could still very well be early in regards to this move, and there could still be substantial upside in the Russell 2000 over this next 2 or 3 years. And it doesn't mean you won't have a correction here or there in the Russell. And when you do get that correction, the Russell, like let's say the Russell rolls into year end and then rolls into the beginning of 2025. And then let's play this out, right? Let's say it's springtime 2025 or summertime 2025. Boom, major correction. Let's say it happens to all indexes, not just a Russell. S&P 500, NASDAQ goes down, Russell goes down, right? Oh boy, everybody's going to be end of the world, end of the bull market. You know, that was fun while it lasted. It's all over. It's all over, right? And all of a sudden, boom, steep drop in all indexes. For whatever reason, I don't know, trade war tensions, inflation starts going up again, whatever the reason will be. There's always a reason to throw when stocks go down, right? And they'll throw a reason out there or multiple reasons. That will be why the market goes down at that particular time, right? And so then people will say, oh, that's the end of the small cap run, bye-bye, right? All to maybe get a pie in the face, and then a few months later, the Russell's even higher than it was previously. So keep that in mind, right? That is something to keep in mind there. Now, in regards to some of these opportunities in small cap land and some of these stocks, right? Look at a stock like Honest. Incredible move. It's up 165% year to date. Keep in mind, go back to October, November of last year, 2023. Honest was $1 and some change, right? And now it's $8. I mean, just a ridiculous return profile over the past 12, 13 months in the stock. But year to date, it's up 165%. You might think, is this move done? Is it overextended? Like, what is going on here, right? I'll frame it like this. Honest is a company that right now, there's no debating, Honest is at the healthiest they've ever been in regards to that company. Revenues, amount of customers, market share, margins, profitability, everything's the healthiest you've ever seen it in regards to Honest, right? The business is by far the most well-run you've ever seen. The management team's got it all down. But keep in mind, this stock is still down over 50% from IPO. 50+%, right? So this baby has a long way to climb just to get back to that old IPO price, even after this incredible move. Now, will it go there in a straight line? I don't think so. I think it's going to have corrections along the way and, drama along the way. And, at some point they'll report a quarter that finally is like not the best quarter they've ever reported or something like that, right? And everybody will give up on the stock short term and then it will come climbing back. But this stock still has to over 2x just to get back to where it was just a few years ago. So that's something to keep in mind there. And remember, once again, this business is in a far better place than it was back here. I can tell you that. Look at the financials of the company back here. Look at the financials nowadays. And it's a night and day difference in regards to this company. So when I look at a stock like Honest, now I'm up $101,000 on the stock in one of my portfolios, right? I don't own it in the public account, but I own it in one of my other portfolios, 50,000 shares I have. I have no real interest in selling these 50,000 shares or even a portion of these 50,000 shares right now because there's no like real incentive for me to do that other than like I made money. Well, I make money in a lot of stocks. It doesn't mean I have to take a profit, right? And I already have money in cash. So it's not like I really need money to put over to cash. But when I look at Honest, I'm like, this baby still likely has a long way to climb. This could be a $15, $20 stock a year from now or a couple of years from now. So there's no incentive for me to sell. Like if the numbers weren't good and it wasn't justified and it was like, whoa, man, their numbers are rough. No. But I'm looking at revenue skyrocketing. I'm looking at everything coming in better than expected. Revenue coming better than expected. The net income coming in better than expected. Gross margins have exploded higher over the past year. Net margin, that's exploded higher over the past year. Cash flows that have built insane. A cash balance on the company of $50+ million on a small cap. $50 million plus with no debt. Come on, man. And I think that cash balance could easily build, especially if they aren't doing any acquisitions anytime soon. Like this could be a company that has $75 million, $100 million of cash on the balance sheet a year out from now or so. So, I mean, there's no real incentive I have to take profits in regards to a stock like this, right? If the stock was $20 today, $25, I might feel different. And I might say, okay, let me take $10,000 off the table, or excuse me, not $10,000, 10,000 shares off the table or 20,000 shares, but at $8, yeah, whatever. I'm letting it ride and whatever. If the stock goes down to 7 in the short term because of whatever reason, I don't care. I'd much rather, not play the game of it might go down to 7, so let me get out. I'd much rather hold this and feel better about it being at 17 than feeling bad about myself because it went to 7. Like, who cares? Who cares in the end, right? As a long-term investor, it means nothing. And I remember I held this stock all the way down to $1 or something a share. So for me, like holding now, this is easy peasy lemon squeezy in regards to this 50,000 shares, right? I've had those shares for a while now. Revolve. Now in the public account, right? This position I have in the public account, just one of the 6 stocks I have that's up over a double up, right? Revolve's now up almost 200% for us, 197%. Another $8,000 up on this stock here today, RVLV, right? Check this out. Revolve is still in recovery, folks. Still in recovery. If we go back to 3 years ago, November 2021, this stock was $85 a share. It's 37 today. I mean, this stock still has to climb, it still has to well over double up to even get back to where it was 3+ years ago, right? So this is a long play in regards to Revolve and kind of what's going on here, right? Look at Revolve's latest income statement. This is another one. I'm like, the consumer recovery really is going to be seen, in my opinion, in 2025 and 2026. So we're still early in kind of like even the consumer turn. Like I really don't think we're seeing that till next year, right? Net sales increased $26 million for the company year over year, while cost of sales only went up $14 million, which means gross profit's going to go where? Up. $144 million gross profit from $133 million gross profit. Income from operations went to $14 million plus from $324,000. Net income went to $10.7 million from $3.1 million. Diluted EPS went to 15 cents from 4 cents. And their diluted share count, they brought that down substantially because they got big buybacks on right now with a phenomenal balance sheet. So when I look at Revolve, I'm like, this is another one I'm looking at, and I'm like, there's not really a huge incentive. Like, I've thought about it. I've thought about, like, maybe I'll cash some shares in Revolve, but I just don't have a big enough incentive right now. I just don't. Like, if the stock was $70 or $80, I'd feel very differently, right? I'd say, let me take 700 shares off the table here, or 1,000 shares, or, maybe sell a whole position or something like that. But here, I'm like, man, even though I'm kind of like, maybe I still doesn't make that much financial sense. And additionally, I think the setup's pretty good for next year. Analysts, I believe, are too, bearish in regards to numbers. Keep in mind, 1000xstocks.com. We're looking at kind of what analysts are thinking about for these companies, right? In Revolve, analysts are at less than double-digit earnings per share growth next year and less than 10% revenue growth. I have a pretty strong feeling, based upon the numbers I'm seeing from Revolve, and also the fact that I think there's going to be a decent consumer recovery next year. I think there's going to be double-digit revenue growth and double-digit earnings per share growth for Revolve next year. And I think it's going to be quite substantial. And so then next thing you know, if all of a sudden Revolve gets back to 20% type revenue growth, you know what everybody's going to start talking about? Revolve's a 20% plus grower again. And that's when this stock was valued back at $80+ a share, that's when the company was growing revenues consistently 20+%. And people kind of thought about, well, Revolve is going to grow revenues at 20+% year in and year out. We're gonna bid this stock up, and that's when it went to $80+. So the moral of the story is, in regards to this one, if they get back to that 20% plus revenue growth, look out. Like the move, a double's coming. If that was to play out there, keeping that in mind, right? No, Fubo, I'm looking at this one, and either I'm really dumb or I'm a freaking genius on this one. And I don't know which it is yet. I'll be honest with you guys, because I'm looking at this company, everything's going better and better for them. The legal stuff is going better and better for them on the legal front, right? Subscribers keep going up for them. The revenue, look at the trailing 12-month revenue for Fubo and how that continues to build out, right? And that should continue to build out over this next many, many quarters and many, many years. So that's all going phenomenal. So the top line's there. Like, the top line's amazing, right? And then we look at the bottom line, look at the earnings per share, and, now they're starting to take these small losses. We could easily be talking about profitability in 2025 and start talking about when are they going to hit a profitable quarter, and then when they do hit a profitable quarter, how much is it going to be? So the talk in 2023 and before was like, how insanely big are the losses? Talk in 2024 around Fubo is how small the loss is going to be. 2025, the talk's going to be which quarter are they going to hit profitability? And when they do hit profitability, how much profitability are we talking? And those are very, very different conversations. So I'm looking at a stock like Fubo, and I'm like, geez, this one might be this one might be setting up like for a pretty epic run, but we'll see. We'll see. Maybe I'm wrong on that one. I'm just like, I've thought about it so many times. I'm like it looks pretty darn attractive. So I'm willing to risk some level of capital. Now, let me say this though. It's very important when we talk about one of these companies that technically is still a money loser, like a Fubo, right? And that's $1 something a share. Keep in mind what I said in the video that I published back in September, right? Beginning of September, I did a video called 16 Years of Stock Market Advice in 52 Minutes. It's my favorite video I've done this entire year in 2024. And if you ever see that thumbnail on YouTube and you got 52 minutes on your side, watch that video, because it will be, in my opinion, the most valuable video you will have watched in 2024. How much you'll be able to learn and pick up from that 52 minutes should be phenomenal, right? But one of the many points I bring up in that video, which I bring up a lot of points in that 52 minutes, is watch out for unprofitable stocks, right? And if you're going to ever buy unprofitable stocks, make sure you keep position sizing small. It's very key, because keep in mind, a stock like Fubo, if that one turns out goes from $1 to $10 or $20, something like that, like you don't need to put a lot of money in it to have made like game-changing money in regards to it, right? Where people get into trouble with these sorts of stocks is they essentially put in too much money, they take too much of a risk. Let's call it that, right? And then the company doesn't work out and it goes BK or whatever, and you're stuck in a bad situation, right? With a stock like Fubo, like sure, it's a risk. That's why it's $1 a share. But if that upside works out, it's phenomenal, and you don't need to put a lot in to get insane gains out of it, right? So you just always have to keep position sizing small in regards to those ones, right?